Okay, we're running. Apologize, we're running a little late today. It was my technical glitch. I was finishing another webinar and wow, I came in late. So my sincerest apologies, everyone. Good afternoon, and once again, welcome to another great session, the KoreSummit webinar series 2021, where we are discussing everything about crowdfunding, equity crowdfunding with Regulation CF, Regulation A+, and of course, Reg D. We cannot not forget that regulation. And today we're going to be having a discussion, obviously, around Regulation CF. And one of the perks that the regulators have thrown in, there's still lots of questions, and we're going to jump into that. And my colleague, who you have met before, but you know what? It never hurts me to hear it again. I want to know who you are. Please, Marty.
Yeah, thanks. Again, you have probably heard it before if you've listened to any of these other webinars, but Marty Tate, I'm a securities lawyer based out of Salt Lake City, Utah. I've been involved with, I've been practicing in public and private finance my whole career, but I've been heavily involved in private finance, particularly using the Jobs Act since the very beginning. Started actually in 2009 with my first crowdfunding client. So, and continue to represent platforms, issuers, service providers in this space.
Well, and like always, man, he likes making an entrance. Isn't this the second? He's done this to us twice now. The man with the entrance. I love the background. I love the shirt. Please. It's good to hear from you, Mark. Please introduce yourself.
Introduce myself. Yeah, I apologize for the background and the shirt.
Yeah, but you got a haircut, so.
I did get a haircut, so that's an improvement. Yeah. So yeah, I'm Mark Roderick. I am a clone of Marty in all whatever Marty said about himself and his practice. Yeah, I've been in the crowdfunding space forever, which really isn't a long time. You know, it's only about 8 years, but time flies by, and represent a whole bunch of portals and issuers, and am a big fan of Oscar. I think that's why we're all here.
Thank you, Mark. I really appreciate that. And again, I forgot, my name is Oscar Joffrey. So we're going to have a fun discussion. As I said, I just came from another webinar, and I was sharing some of the notes with Marty before you came in, Mark. And it's going to be very timely to this because, you know, people read the regulation like this. Oh, Regulation CF, great. You can raise 5 million. And did you know now you can put everybody under an SPV? But nobody asked the question, what's an SPV? How do we get it set up, and what's different? Oh no, it's really simple. You'll put all the shareholders under that umbrella, and you know, and under your cap table, it's going to show as one. So everybody in the audience is jumping up and down, excited about this, which we should be, but we need to get there. And this discussion today is really, we're so close. We're only only a couple of weeks away from the grand day. And because of that, there's still some questions that need to be asked regarding the structure, which we had a previous discussion on Reg A, but in Reg CF, whether it's safe, you know, to keep using the SAFE and the SPV. And so I'm not going to, I'm not going to work on the element of what's the difference between the two, but I do want to work on the SPV side because it's one that's coming at me a lot. And I'm going to put both of you on the spot like I always do to see if you put some more thought into it. What do you envision with it? And obviously, so first let's start with what is an SPV. So I'll start with you, Marty. Let's go with that. And then let's bring it down to how this will affect a Reg CF company and how we can structure one.
Yeah, so SPV, special purpose vehicle, or SPE, special purpose entity, is an entity formed just for that, for a specific purpose. Typically, it's formed as a entity to collect investors that will then go turn around and make a single investment. It's also, the S is interchangeable too, because it can be called a single purpose vehicle. The single purpose being making this investment. They're used a lot in real estate, a lot in Reg D offerings, a lot in syndications on real estate, and they're used a lot in like I said, the Reg D world, where you'll have accredited investors go into an SPV and invest in an offering, an issuer's offering. I know that groups like Seed Invest and Angels List, really, this was the model they used. But it was previously has not been available for RegCF offerings. So that's what we're going to talk about.
Okay, that's perfect. So we've given the what traditionally it looks like. Okay, Mark, let's dive in. I mean, you know RegCF more than I know you two. This weekend helped me out, so I want to say thank you first of all. Not know, but so give me,
Sure.
How is that going to apply now to a company, knowing that we don't have not too much guidance on it?
Well, yeah, I'd be happy to. And I mean, the big news, which I'll explain what I mean, is that this was a change in the law that was absolutely not needed and in practical terms has no effect for better or for worse. It is a change required and made solely because of a misunderstanding of what cap tables are by the entire investment community or by a large section of the investment community. So this was the lay of the land, or it continues to be until these new rules come into effect. In RegCF and in Reg A for that matter, but let's just talk about RegCF, you are not allowed to raise money using RegCF for a so-called investment company. The Investment Company Act of 1940 defines the term investment company, and it basically means a company that owns securities, that exists solely to own securities, like a mutual fund. So you can't use RegCF for a mutual fund. And SPVs of the kind we're talking about exist, as Marty said, for one purpose and one purpose only, and that is to hold the stock of the operating company. So if, for example, you have, company XYZ and it's creating a great new social media app, that's the operating company. You could have a SPV, a new entity, typically an LLC, that exists solely to own stock of XYZ. Why would you do that? Well, you would do it because the owners of XYZ worry about having a messed up cap table. They worry about having too many entries on their cap table, too many owners, too many shareholders. They're concerned that if they have too many shareholders, that's going to keep them from raising capital in the future somehow. So if they're, say, raising money from 500 RegCF investors, they're saying, oh my God, we're going to have 500 new entries on our cap table. That's going to be terrible for raising money in the future. If we could just put those 500 people in a separate LLC, and only that LLC will own our stock. So now we only have one entry on our cap table. Wow, that's fantastic. That'll make it easier for us to raise money in the future. That's why this rule is being implemented, because of that thought process. You couldn't do it before now because that SPV that owns the company's stock, that is an investment company under the Investment Company Act of 1940. And the change to allow this all to happen is a change to the Investment Company Act. It's not a change to the crowdfunding regulations. It's a change that says, for purposes of the crowdfunding regulations, this kind of entity will not be treated as an investment company. Okay, so that's the technical change being made. So now we can funnel all those 500 people into this one entity. Now, what problem exactly is this supposed to solve? One problem it doesn't solve is all 500 people have to get K1s, right? It's not as if you can only send out one K1. Yes, you send one K1 to the SPV, but then the SPV, which has to be managed by the company itself, now it has to send out 500 K1s. So you haven't saved anything there. What about voting? What about having all these people vote? No, because if you're issuing voting securities, then the rule is that that SPV also has to issue voting securities. So if there's a vote to be taken with respect to the underlying company's stock, it's true that only the SPV gets to vote its shares, but all 500 investors get to vote on what the SPV does. What about things like preemptive rights? Well, again, if you give the SPV preemptive rights, then you make it harder for future rounds of financing. The point is, if you issued the right kind of securities, and let's say the simplest right kind is just non-voting common stock, right? It doesn't matter if you have 500 people on your cap table. It doesn't keep you from raising money in future financing rounds. Putting those 500 people in an SPV has absolutely no bearing on raising money in the future. It's just the perception that this is an issue has driven the creation of this new SPV rule. So, and I'll shut up in a second. Some RegCF sites like WeFunder, for example, and they might have been the ones who thought of it, they pretend to create one entry on your cap table now through this complicated, there's a transfer agent and a voting agreement. It doesn't create one entry on your cap table. It's a deception. It's a deception that doesn't hurt anybody. But the reason they did it, went through these steps and this additional cost to create a deception for their companies and their investors, is again this misconception about cap tables. So as you can see, I don't really have an opinion about it. But
no, actually, Mark, that was, thank you. I let you go at it because I didn't know any of that. And that's really interesting to hear the backdrop to all this, because everybody makes it sound like it's such a big deal, but it really isn't a big deal.
It is an absolutely meaningless deal.
Yeah.
If you're going to screw up your cap table, if you're a company and you issue 500 investors non-voting common stock, you have not screwed up your cap table.
Agreed.
If you issue to one investor, for example, that the investor has preemptive rights over future issuances and has the veto rights over future stock issuances, you have screwed up your cap table with one investor. It's not the number, it's the terms of the securities that you issue, which the new SPV rules has absolutely nothing to do with. So this is an instance where the SEC has adopted a rule purely to respond to a sort of marketing, a confusion issue, as opposed to a substantive issue.
And thank you for saying that word confusion, because I'm dealing with that right now. And you're right, it's confusing. And I'm just going to add a little bit to that, because we have seen this model where investors have invested directly in the company. And now the company is doing another RegCF, but this time they decided to use this deception model, you call it. And they go, well, wait a minute, how come I don't see my shares that I own in the company? I'm sorry, you don't own shares in the company. You own shares on that other. What? That's not what they showed me. And it's really interesting. That's not what they showed me. This is the interesting part. And companies, I'm only giving this as a heads up. I like what you said. It's not about the numbers. It's about the terms. Because I would say, listen, would you rather have one shareholder that's got the right term that controls, or would you like 10,000 that one by one? It's you can manage that. The technology is definitely there. There's no excuses.
Yeah, it doesn't matter anymore. Click a button, and you can send out 10 K1s or 1,000 K1s.
Agreed. There's no. So you've heard this conversation, Marty. You and I were just starting to, because the last webinar we had, the conversation got started, and it was sort of we go right into the SPV. Mark added a bit of groundwork that I didn't have, and I have a different view now. But that being said, one of the discussion points we discussed was, okay, if we're going to do it, we have no guidance from the SEC on a number of issues. Can we talk a little bit about that? If there was an issuer that's going to use it, what are some of the issues outside of what Mark just mentioned?
Well, and I don't want to say we don't have any guidance, but we don't have a lot. I think there's a lot of, the funding portals that elect to use this are going to have to fill in some gaps and understand. But, one of the issues that we talked about, I think on another one of these was, who's going to manage this? And the SEC provides that the issuer has to, this is a responsibility of the issuer to, they don't have to set it up themselves. They could use, the platform can help them set it up, but it's ultimately their responsibility, the issuers, to, over the management of this company. They can be reimbursed for expenses associated with that. But so that was one of the things that we talked about is, okay, who's, or is there going to, or some of these third-party SPV companies that, that's what they do, is just manage these SPVs. Are they going to fill in the gap? Maybe, and there's doesn't say anything about outsourcing that responsibility, or seeking some, I guess, SPV, some administrative assistance and doing things like K1s. But so, there's some, I think it'll be interesting to see how that's set up. One of the issues that, although I agree with Mark that you're right, if you issue non-voting common or non-voting, if it's an LLC, if you create an interest that doesn't have voting, that does solve a lot of the problems. But if you're an LLC, you're going to issue K1s anyway. So setting up an SPV to invest in your LLC isn't going to necessarily help. I think one of the big things, and maybe you'll get to this, Oscar, and I'd be interested to hear Mark's take on it. And maybe it's just a non-issue because nobody's really getting close to this number. But one of the potential benefits of an SPV is that all of the shareholders that come into that SPV, as long as they're natural persons, do not count towards the shareholder count under 12G. So that if they're a natural person and they come into this SPV, they don't go towards that 2,000 limit on or threshold that would trigger, you having to become a reporting company. So that is a potential benefit. However, I don't know how much of a practical benefit that is because, I don't know how many of these companies are selling, shares to or are having thousands of purchasers in their offerings. So, but that is a potential benefit of this new role that I think is something that I've actually heard you address, Oscar, and one of the reasons why it's wise to use a safe. So
yeah, I have a question on that. You brought up an interesting point, so I'll ask you, Mark. So I got put in an SPV. I thought I invested in the company directly. Oh, I heard the company made an agreement with a secondary market ATS. My security is off the 12-month hold. This holder is really not the holder of the entity. So so they don't count. Therefore, they don't have the same privilege as the people that are sitting on the direct cap table of the company, correct? Or does the SPV itself trade on behalf of everybody?
The SPV itself. Yeah, that would be about the dirtiest trick a company could play on its RegCF investors. The good news is we're listed on an ATS. The bad news is you're not included. So they would, I think they would definitely list the SPV on the ATS. And by the way, we're ATS meaning alternative trading system, meaning a secondary market for your shares. But you and Marty are absolutely right that it is a separate entity. If they do it that way, it is going to be a separate entity. So you would have to list both the issuer and the co-issuer. For securities laws, the SPV will be the co-issuer on the exchange in order to give liquidity to the investors. You were absolutely correct.
Perfect. So I think, so one more question on this. So you alluded to this, Marty. You said that the SEC has provided some guidance. So is there a bit of a framework? Are we still in the early stages yet that, first of all, whoever's going to use this first, you really need to understand your capital raising journey, because as to what Mark and I are saying is that it could derail, it could cost more, it could be deceptive, you name it. There could be you need to understand everything about it, which up until now, nobody knew that. So thank you for that, Mark. It's really opened it up. I'm gonna really put this in kind of a charts. Is there anything else, Marty, that you would say regarding SPV that a portal or a company needs to consider before they engage with it? And I mean, the last conversation we had, one of the things that we were talking about, whether it could adopt the nominee model inside the SPV. Do you recall that? What the Europeans do, where they put a nominee in charge of all the investors, but that's not what the SEC intended here with the SPV, correct?
Correct. And so, where I have a lot of familiarity with this, as I said before, is in the Reg D 506C world, worked and represented a company that was their job, as they would set up these SPVs, and they had, under that model, basically they would designate a third-party manager. That manager would have the authority to make all of the decisions on behalf of the SPV. So those interest holders in the SPV really didn't have a vote. The way that those were set up is basically that if something was presented to the shareholders, that the manager would vote on behalf of the SPV, and they would just follow whatever the majority of the people were doing. So if it was a corporate action, they would, a merger or something, they would approve. They would just go along with what everybody else. Here, it's a little different. It's basically, if you're issuing voting stock, like Mark said, everybody's got to vote. So that means you've got to go out and get, do a solicitation on a consent solicitation on that, and for whatever corporate action. So that's a complication that I think is going to be interesting to see how that's dealt with. Again, that might just be outsourced to a third party, but that's an additional expense that goes along with that. I think you did raise an interesting issue about that, about the secondary trading, and it'd be interesting to see how, in most of the cases where I've seen SPVs used, that's not an issue. They're doing like more of a venture capital type investment. Secondary trading isn't something they're thinking about immediately. And they would, they know they're just sort of holding until there's an exit. I imagine that would be the same thought here. But again, if that's the case, I don't know why you would use I guess there's not as compelling reasons to use an SPV as you'd think.
Yeah, let me jump in and say the term SPV and the concept of using an SPV is, in practice, has traditionally been a very open-ended term about what the SPV might look like and what its internal organization might look like and so forth. And I don't want to leave people with the impression that, as adopted in the new SEC rules, that it is open-ended, because it's not open-ended. The rules are very, very stringent about what this SPV has to look like. And in short, without listing the rules, the SPV is supposed to be an exact mirror image of the original offering. So the investors have to be required to be put in exactly the same position as if they had acquired the securities of the issuer from the issuer and were on the issuer's cap table. So, it's not a situation where you can issue one kind of security to the SPV and then, let's think of another kind of security to issue to the owners of the SPV. It has to be the identical security. So there's very little flexibility. And people have asked me, well, can I form an SPV to now invest in a lot of different RegCF offerings? No, That's not what this is about. You know, and SPV is specific not only to the issuer, but to a particular RegCF offering. So, you know, if an issuer does one RegC offering using an SPV and then does another offering, it's going to be another SPV. It's very constricted to serve the very, very limited purpose that the SEC was trying to accomplish, which again was only about marketing and market confusion, and wasn't. They're not trying to they're not trying to liberalize anything or allow for any playing around. They are just trying to say, okay, all these people wrongly believe that if you have a lot of investors on your cap table, it somehow is going to mess you up. So here's this mechanism, so you can only have one member on your cap table. Go for it.
You know what
the term they use is, I was going to say, the term they use, it's a conduit.
It's a conduit, exactly. Yeah. Which kind of says it all, right?
Yep. Yeah, no, it does. It does.
Purely a conduit.
Yeah, I've heard that argument. Oh, who the heck wants all that in your cap table? You know, they keep thinking that we're still managing cap tables on paper, which is
true. That's you know, true.
I just don't see how, but that's okay. That's part of the education.
Well, here, let me just, you know, since we're never shy about sharing opinions here. So this has been part of the pushback from the organized institutional investors, like organized angel investors and VC funds. You know, all those folks properly see crowdfunding as a threat. You know, crowdfunders are the disruptors of the VC business model. And from the beginning, they have thought of these various spins that they could say to company founders to dissuade them from using crowdfunding. And this is one of them. You can't do that, you'll screw up your cap table. So it's not exactly an accident that people think this. It's a myth that has been intentionally put out there, you know, this is not the grand conspiracy theory, but you know, to keep founders away from equity crowdfunding.
Wow, that's our topics are always enlightening because we open up a whole new area. But listen, guys, you know, it's good. Yeah. Listen, this is what this is about. This is about discussion. Look, we're all in a learning curve. I mean, I know you guys been as deep in as I have, 10, 11 years into it, and people go, wow, that's a long time. No, we're just getting started. You know, the education continues. Yeah. If we look back at our webinars from 10 years ago, you go, wow, well, that's what we had then. Look what we are now. So it's good to see.
We didn't have webinars. We didn't even have color. We didn't even have color TVs 10 years ago, did we?
Well, they did, and over here we had it in Canada.
One point that you know, to go along, or maybe it's contrarian to what Mark was saying, but it's interesting. I've heard both sides of the argument. I have represented, you know, companies that had done a RegCF round, and they were going out to raise capital, and you did get some, you know, I want to say pushback from the VCs that were saying, you know, we don't like this. We don't like that you have all these investors. We need to figure something out with them. You know, in fact, to that point, we, you know, created voting trusts and so forth to try to deal with that. And again, that's not universal, but that can happen. So I don't want to say that that's never happens, but it can. But I've also seen the converse where people have said, hey, we want you to do a crowdfunding raise first. If you can go out and raise $1 million under a CF round, then we'll come in with a Series A, you know, because they want that sort of proof of they want you to go out and market it and get the sort of ancillary benefit of doing a crowdfunding raise of raising market awareness. So I think there's arguments on both sides.
There really is. And I think VCs are starting to, like, during our Series A, we did have some terms where they were prohibiting us from doing a Reg A. And for us, that was a non-starter. This was our path. We knew our journey. So this is important as any entrepreneur. These vehicles are great, but you got to know what you want to do. And if you're going to deter from it, you got to understand the impact of everything you've done and said. So for us, we knew it was this Reg A, that was it. And anybody
that's funny. Given your business, Oscar, they were going to tell you couldn't do a Reg A.
I know. It was hilarious. It was part of the terms, and I go, but it seems sensible. And they go, no, we would want. But I understand that. But we did get VCs. I am letting you know, we did find VCs that.
There you go.
There is, just because one said no, they're all not like that. So to your point, Marty. So I want to move it now into, so we talked to the SPV. We needed to talk a lot about it because it's the new one. But the other instrument is the SAFE. So I'll go to you, Mark, on this. What is a SAFE? Why has it been so? Obviously, it's been the instrument of choice so far based on our information we have. So can we walk through that?
Sure. And I will warn you in advance, I'm not nearly as opinionated about safes as I am about the other stuff. A safe, the letters, it's an acronym, simple agreement for future equity. So back in the old days, 10 years ago, people, you have a startup company, it thinks it's going to raise a lot of money in the future, but right now it's just raising a little money. And, the whole company consists of a founder and maybe a chief technology officer and a great idea, but not much else. And we're raising $1 million just to get started, hire some other team members, do some market research. And so we now say, okay, we're going to sell stock for $1 million. And the investors say, well, how much am I paying? How much stock am I getting for my $1 million? And the founders and the investors get into this impossible discussion about what the company is worth, because who the heck knows, maybe it's future value is $1 billion, but maybe its future value is $4.99 at Safeway. So it's an impossible and fruitless negotiation. And so long ago, people came up with the concept of, okay, I'll tell you what, for right now, we will lend you this $1 million. It's just a loan. And then it converts when you raise maybe $5 million. And at that point, by definition, everyone will have a better idea of what the company is worth. Then our note will convert to stock at the value at that time. Oh, that's a good idea. And then even that was, okay, a note, we can't pay you interest, so why are we charging interest? And that's how the SAFE was born. So a SAFE is a convertible note that isn't a note, and it just says, here's the $1 million. We have no idea how much stock we should get. You have no idea. So we're going to say that right now it's just nothing. It's a nothing, but when you raise, say, $5 million in the future and you have a pricing round, what the company's worth, we will get stock at that time, at that price, but typically for a discount. And there were some other complexities in there that I won't go into. So it's just a way to avoid an impossible negotiation over value between a founder and the founder's early investors. And it's a very, very widely used instrument. At some point, somebody, and maybe one of you knows who it was, wrote an article saying that safes are inappropriate for RegCF because, and now I'm kind of making this up, because the dumb people who invest using RegCF are not smart enough to understand what a safe is. That was almost the explicit point. And the SEC in the initial draft of these proposals that came out last March jumped on board with that argument. Yeah, safes, they're just so complicated. And I'm all for protecting small investors and so forth. I've never really understood that argument. I mean, I think common stock, try to explain to a layman what common stock is, what you get for that piece of paper. That's a really complicated instrument. I don't see safes as being more complicated than that. So, but they were, through the comment period, the SEC was persuaded not to prohibit safes. So we still have safes, and they're a very popular instrument. I personally don't see anything wrong with them. Now that the limit is going from 1 million to 5 million, if it is, a safe makes sense when you're raising $200,000. If you're raising $4 million, it probably makes a lot less sense, because $4 million would typically be a pricing round. You would decide what the company's worth at that point. But anyway, that's all I have to say about safes. I think they're perfectly appropriate. Do you disagree with that, Marty?
No, I've been on record saying I don't love the safe, and I warmed up to it, I guess. Early versions of it you saw were very, they might have fallen into that, the reason for that article, because they were very non-friendly to investors.
Really?
Basically, they were. I've seen safes that acted like debt that never had to be repaid. And one of the risks, and I guess it still, can exist in certain versions, is if you never have that qualified financing, you never have that next round that would automatically convert these interest into, safe interest into whatever the security that's offered, whether it's Series A preferred or common or whatever in that next round, then you potentially could just be, the investors could just be holding this instrument that says, hey, I could convert potentially, but maybe if the company never has that liquidity or that qualified financing, then it would be worthless anyway. So I didn't love them at first, but I think that you're seeing an evolution of the instrument, and they are more investor friendly. And I actually do agree with you that, and I'm dealing with this question right now with some issuers that it's perfect if you're raising 200,000 or 500,000, but if you get into a $5 million raise, then again, that looks like something more of a pricing round. And a lot of companies, if they go out and raise, if you raised $5 million on a safe, I don't know what that, if you're going to, sometimes people don't need more than the 5 million, right? I mean, and having to convert that in the next financing. Is there going to be a next financing? I don't know. So
that was at least now, Mark, what we know is we found the author. So that's an important part. So we know who that is.
Oh yeah, Marty. No,
yeah,
wasn't Marty.
Yeah. So one thing I'll say about the safes is this, that I like the instrument. I agree with you. I concur there. What I don't like about the instrument is that it's too much one way. Right now, it's 100% towards the company. I think if the company is really going to, or where, obviously these are coming from the platform, they need to balance it. They need to balance it where the investor has not protection. I'm not referring to protection, but at least have some sort of sight that something may come out of it. So, because we've been on the other side where the company chooses just to pay them out and knowing that they're going to do another capital raise, right?
Okay.
So you used our 500,000 or $1 million, and we only got one client right now. It's one that you and I have, Marty. He goes, can I just buy it? No, don't do that. You do that, you destroy the whole notion of it. It is what it is. They got to that first capital. You're here in Reg A because of it. and you need to, because you need to become the first, because it hasn't been done yet. Our client will be the first one, Marty. Will be the first conversion of RegCF to shares, and I think this is the success. This is the only way we have some measurement to where it goes. So I have one question on a safe though. The reason it was put into a safe, would it have anything to do with Rule 12G, or is it irrelevant on that, Marty?
Yeah, I've heard you actually bring up that point in another discussion, and I think that is a valid point for using it. But it goes back to that question of it allows you to, to go out and, I guess, sell to, over 2,000 of these things without triggering that the reporting requirement. But again, I don't know. Is that happen? Have people had more than 2,000 investors into a safe? I don't have that data, but I think that's a good argument.
Do you think a safe is an equity security for purposes of Section 12G?
I don't. Do you have a?
I do.
What
I do.
You do, Oscar. What do you think, Mark?
Whichever one of you is willing to buy me dinner, I will agree with you on that. I think it's. I think
I'll do it.
I think for purposes of Section 12G, I think something is either a debt instrument or an equity instrument. I don't think there's anything in between. I think a safe, nowadays a typical safe says, but if we hadn't had a conversion in 3 years, we get our money back. Does that make it a debt instrument because there's this concept of getting paid back? Or would you say everyone knows the real value of this instrument is future equity, in which case it's an extra equity instrument? I don't know. I don't even,
to
I
me,
feel
it
about
looks,
50-50.
Yeah. And I don't know either. To me, it looks more like debt, but that also begs the question, then why not just go out and offer a convertible note? Because there are differences between a convertible note and a safe, right? So
there can be. I mean, they don't. Yeah. There doesn't have to be.
But there can be. Yeah.
One of the things that happens with these instruments is someone creates a form that is, let's say, neutral as between company and investor. But then the first lawyer who uses it, let's say, she's using it to raise money for some company. She says, well, my client's the company. So I'm going to put in some provisions that are favorable to the company. And so it quickly becomes, not neutral, I guess I'm saying. So we're using the term safe as if it has some static meaning. As you two have pointed out, there are good safes and bad safes, actually. So, it's not just one thing. It can look exactly like a convertible note if you put in enough provisions.
Yeah.
Yeah, I believe that's the graduation. Personally, sorry, I didn't mean to cut you off, Marty. I feel like the safe needs to go up one level, but go on.
Oh, I was just going to say that, yeah, we have seen that. I mean, you raised a situation that I'm dealing with another client that, they're growing and they're having a Series A, and they're on a Series B financing, but they have this RegCF round that they did, and they have these safes out there, and the terms of that say that the company has the option to convert them, or they can buy them out. And so it completely goes against, these people took a risk, and now the company's like, and luckily the company wants to do what's right. So it, and says, we want to make sure that we take care of these investors, but they're also kind of looking at this chance and saying it would be nice to clear up our cap table a little bit and get rid of these 500, investors that came in. So, if you look at the terms of that safe, it says, yeah, they can just buy them out. So,
and that's awful. I mean, that would be, I think we would all agree, that would be completely unfair.
I've had to do that already more than 5 times.
Yeah, that's
awful. My message to the CEO of that company, I go, I hope you never come back to crowdfunding again, because you know what? That's not what this was about. It's just that now we're ready for venture money. Well, you know what? You better make sure they ride you all the way through, because the people that got you there, it's really, it is. And the other one, male versus female CEOs on this, is really simple. Males will make them cash out. Females, it's quite the opposite. They embrace it. Now, I had one client that was on borderline, and I pressed them hard. I would even walk. I said, look, I'm your provider, and I would walk, because that's not what I stand. I didn't work 11 years of my butt giving away all this so you could take advantage of the regulation, the very people that got to it. But it's so many people, then you shouldn't have done it in the first place. It's simple as that. So we got some. So let me ask you this then. So we've been talking to SPV share, say, then why not shares? I mean, what is so wrong? Why did we need to create a safe or a no? Why not just say, the investors are, to be honest, if people are saying they can't read a safe instrument, which most don't until afterwards, the valuation isn't really the reason they're investing anyway. I mean, we're seeing that in Reg A. So why not put them in shares? Is there a particular reason you can think of, Mark?
Well, our investment world today, like it or not, is shaped by Silicon Valley. So all these instruments, even convertible notes and certainly safes, these were all invented in the Silicon Valley ecosystem. And in that ecosystem, it really was, we don't want to argue about value for a startup company. So, there was good reasons. Now we take that out into the, America at large, and maybe that reason isn't good enough anymore. To answer I do think for small companies raising small amounts of money, valuation is an issue. And I think a safe is that's a valid reason to issue safes. Technically, if you ask a lawyer, why not just issue common stock? A lawyer could say, well, because stockholders by law have certain rights. No matter what you do, stockholders have certain rights to see your books and records, to complain that you've been paying yourself too much salary, stuff like that. And so, as I think a typical corporate lawyer would rather investors not have those rights. It's the same reason when we're preparing or thinking about implementing an executive compensation plan, we often use something called phantom stock, which is basically a contract right that says to the executive, you have the right to get just as much money as you would have earned, if you owned 1,000 shares of our common stock. Why not just give them the stock? Well, that's why, because stockholders have rights. So that's a reason. I think in the context of RegCF or Regulation A, I don't think it's a great reason. I think companies where valuation is not an issue can feel perfectly fine issuing actual equity securities. That's my view.
I think, but Mark, I think your last sentence is typically where I've gone to justify that is valuation. If it is an issue, if you're saying, what are you worth? And you've got a balance sheet that's all zeros. And like you said, it's an entrepreneur and maybe a CTO and it's hard to go out and say, we're going to sell, we have a $10 million valuation and we haven't sold anything and we're going to, so that, to me, that's probably the best reason to use a safe, is just because you don't need to peg a valuation. And
there's, the other instrument that has become very popular in RegCF, which has the same benefits, is a so-called revenue sharing note. I sort of like revenue sharing notes for that reason. You know, people don't have shareholder rights. They don't care how much bonuses you pay yourself. There's an end date. They're very simple I mean, a revenue sharing note is much simpler to understand than either safes or common stock. You know, I'm going to share in this company's revenue for a while and then I won't.
I like that one. I think that one, we haven't seen that before, at least not in the scale. And I do hope it emerges, because at least this way, if they put in $100 and they get the $100 back, they can go and say, I got my investment back, and then anything else is just reaping the rewards. But it is interesting based on the instruments, whether the success, whether some are using it purely, you know, data is starting to come out. In one end, everybody is praising it for the numbers, but we need to trace that money through all the way until here, so we can actually say it was successful. Did it create jobs? Did it do all of this? So, but for me personally, I've been asking this question a lot lately regarding shares. Why not just offer shares? And again, the only time I would probably think of a safe or a note, it's not even so much about valuation, because I think we all know now Silicon Valley doesn't dictate this market anymore. This is the crowd dictates it. One of the partners we have said it best: I'd rather have 1,000 people telling me they love my company than one investor telling me and then trying to dictate everything they want. And that's an interesting perspective, how crowdfunding works. And so, but if the uncertainty of the company of value and the uncertainty of where they're heading next, maybe those instruments make sense. But if you already know you're going to do a RegCF, and you already know you need another X number of dollars, and you're going to use Regulation D and all that, the cleanest cap table is the cap table you can see and you can visualize and utilize, and that is available today. That's no longer a barrier anymore. And it can be as cost effective as free. So, there are no more reasons not to embrace this. So, okay, so we talked about SPV Safe. You brought in a note that there, Marty. Thank you for that, because I have seen the promissory note, and then of course the revenue share. But revenue share, is that an instrument? Would you call that an instrument, or is that just a more of a tactical element from the?
You would have a revenue sharing agreement, and that revenue sharing agreement and interest in that would be considered. I mean, it's considered a security. So, it's something that we've worked on, and sounds like Mark's worked on as well. So,
it is definitely a security, to answer your question, Oscar.
Yeah, but it doesn't work universally, right? I mean, it's only for companies that anticipate it. I think it works great for companies like, app developers or game developers or something like that, where they anticipate they're going to generate revenue in the near term. Probably not great for like a long-term real estate deal.
No, that's true. I mean, we've always said that it all depends on the company, the objectives, but at least we covered, we demystify quite a bit here. We spent a bit of time on the SPV, which I think historically I have a much different view on this now than I did before. I still don't like them. I don't like them even more now. Thanks, Mark. No, seriously.
I'm going to defend it, Oscar.
I'm gonna again. I like,
of course, taking
the opposite view of Mark, just to
spice things up.
Because I do, yeah, exactly. So I do think that the SPV, and I was somebody that said I think this is a good thing, and I think it will have a benefit, particularly. And I think the one spot would be like a real estate deal, where that's just, and maybe it's just because that's how you typically would see it in a real estate deal. In that capital stack, you would have, you have an SPV that's coming in to fill, the equity portion of the deal, and the sponsor comes in. In that situation, I think you might see it. It's not necessary, but it's definitely. I know that the people that are doing real estate and want to do real estate under CF plan to use it. So I don't think it's like I would agree with Mark that it's not absolutely necessary, but I think that it might serve a purpose.
Well, and don't let me forget, I mean, it absolutely, I do think it will be widely used. Even though I don't think people need it. It'll be widely, I mean, there is definitely a very widespread misperception about messing up cap tables, and founders, you know, the last thing they want to do raising money in RegCF is screw up a future financing. And so if they'll tell you, you know, if there's a 1% chance, you know, they will say. So people are going to use it just because of the widely held misconception. I've already done, you know, I've done forms of SPV agreements for my portal clients because there definitely is going to be a demand for it.
Yeah, I agree. As long as the misinformation about it, how to use it properly, and not understanding the other implications. But again, that's where we come in, right? We got to give them the complete playbook so they understand going in with their eyes wide open. So once again, the two of you have surprised me like always. Mark, it's always good to see you. Your haircut looks amazing, by the way. The black and white is really, you know, and then of course, Marty, it just feels like I don't see enough of you. So just joking. Thank you both. And thank you everyone for another wonderful session of the KoreSummit webinar series, where you can go to KoreSummit.io or our YouTube channel, KoreConnects, and you can watch these videos to help you and understand, demystify. If you want to get a hold of our speakers, they are at KoreSummit.io. Their LinkedIn profile and email address are there, ready to go for you. Once again, everyone, thank you so much. Have a wonderful afternoon. Take care, everyone.